Before you fall in love with the house online, there is one major factor that you need to understand because it controls your entire mortgage approval. It is called DTI. Now, you may have heard it, but I find that most homebuyers don't really have a really good understanding of what it is. So let's break it down. DTI stands for debt to income ratio. In simple terms, your debt to income ratio is the percentage of your gross monthly income that goes towards paying down monthly debts. For example, if you make $10,000 a month and you have $4,000 in debt every month, then your debt to income ratio is 40%. Now, when you go to get pre-approved, there are actually two different debt to income ratios that a lender will look at. The first one is what's called the front end ratio. Now, this is strictly taking into consideration your proposed monthly mortgage payment compared to your monthly income. Second debt to income ratio is called the back end ratio. Now, this one takes into consideration your proposed monthly mortgage payment and the rest of your debts, like student loans, your car loan, and minimum credit card payments. Now, different loan programs have different DTI limits. So for example, a conventional loan typically will allow you to go up to 50% on your debt to income ratio, whereas FHA is a little bit more lenient, so they will allow it up to 56.99%. Now, if you go even 0.1% over this limit, the automated underwriting system is not going to approve it. So it is a very strict limit. Now, here's why this is so critical to understand. DTI is incredibly sensitive to your debts. So if you make one bad decision, it could really mess up your qualification. And honestly, I see this happen all the time. For example, somebody wants to go buy a home and they just took out a new car loan. Now they have a $500 monthly payment. You know, they think, oh, I have enough money, I can afford this payment. But that doesn't matter when it comes to qualification, because that simple $500 monthly payment can really shoot up your DTI. It is very, very sensitive. That single car loan just killed sometimes even hundreds of thousands of dollars in purchasing power. So now you cannot qualify for that house that you want. So don't open your credit cards, don't go get a new car right before you're trying to get a house, because it will probably not work in your favor. If you're looking to buy a home and start the pre-qualification process, I'd be more than happy to help. Shoot me a DM and we can connect.